Good morning and welcome to this Wednesday, October 27th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we've got futures up slightly this morning. This is the last day historically of the bearish period, which hasn't been very bearish. Certainly, markets continue just to put its head down and move higher. We've seen new records on the Dow and the S&P 500. Dow futures, by the way, this morning up 39. S&P 500 futures up about 3, and NASDAQ futures up about 20. Earnings really beginning to pour in. Got some economic reports out, but for the most part, market is really focused on the earnings. And the numbers are coming in way ahead of expectations again. So when you get quarterly numbers that are being beat 10, then you've got you got all your analysts and so forth at these various Wall Street firms that have to go back and redo their numbers in terms of future earnings growth, and it results in higher valuations of companies. So I don't really see anything stopping the market here in the near term. I do still think 2022 could produce some headwinds. We'll have to kind of watch that closely and see, but I think the problem is going to be the market trying to beat not really beat. I think the market will beat next year. I think what could be the problem is the market beginning to feel like we're not producing enough enough earnings growth. So the growth numbers are likely to slow as the demand slows and as supply gets more online. So we'll see, what happens down the road, but I try not to look too far ahead. I tend to be very short-term oriented in my trading. I like looking at the big picture to kind of get a sense of where we're going, but really my focus is more on the short term. And when I say short term, I'm just talking about over the next couple of weeks to a couple of months. And I don't really see anything, out of the ordinary that's going to hold this market back. It just looks like it wants higher prices. We're going into earnings season. We started building prices higher going into earnings season. Now we're getting the earnings, and many of these companies are going up after the earnings. Tesla, a prime example. And so it's just going to be difficult to hold the market back, in my opinion. I think we go higher in the fourth quarter. I do know that some of the charts at stock charts, I'm having problems loading. I don't know if it's my internet because I was having issues with my own internet a couple of days ago. So I don't know if it's mine or if it's just stock charts is having problems loading some charts this morning. But anyhow, I'm going to go ahead and share my screen and take everybody over to Earnings Beats first. So anyone who's new, first of all, welcome. Thanks for tuning in and joining us. And for those of you who are regulars, come in here just about every day that we do this. Want to thank you as well. If you go to earningsbeats.com and you are new, if you scroll down, you'll see right pretty much in the middle of the page, but over on the left-hand side there, you can subscribe to our free Earnings Beats Digest newsletter. This is something I publish 3 times a week, Mondays, Wednesdays, Fridays. Normally just looking for something that's interesting. Either it could be an educational piece or it could be an individual stock that looks interesting. Maybe it's a gap support level being tested or a trend line, or maybe it's a reversing candle. And, could be any of those things, but it's a way for you to learn a little bit more about what we do and how we approach the market. I think it'll help in your trading. Anyhow, all you have to do is type in your name, email address, hit that subscribe button. No credit card required. You can unsubscribe at any time. We'd love to have you. Also, we do a lot of free events, and we do our free events. We reach out to our entire free Earnings Beats Digest community, in addition to all of our members at Earnings Beats, and make sure you get room instructions so you can join the event. So there's definitely a lot of benefits to being a EB Digest subscriber. All right, let's go ahead and look at the market. I'm going to apologize, but these candle glance charts are not loading. I've been trying to load them this morning, and they're just not coming up. Every time I hit the refresh, different ones will show up. So maybe I'll do the ones that are showing and then try again and see if I can get the ones that aren't. Anyhow, as we look at the action from Tuesday, the Dow Jones Industrial Average finished up 16 points. It was well off its earlier highs, though. The S&P 500 finished up 8, NASDAQ finished up 9, but you can see from these candles, the intraday moves were much, much higher. And then we came back down later in the day. The NASDAQ in particular had pretty good volume after being up, challenging that prior all-time high and then reversing down off of it. So wouldn't be surprising to see a little bit of a handle, because this almost looks like a cup. Wouldn't be surprised to see a handle form, maybe a little bit more weakness here in the short term, but I do believe we're going to blast off. And I think it's only a matter of time before NASDAQ joins the S&P and the Dow in all-time high territory. Looking at the three sectors we can see right now, we've got utilities, which were up a little bit more than 0.5%. Healthcare was up about 0.5%. And then the weak groups were communication services, which you can see here. This has been kind of a staple in terms of underperforming for the last 7 weeks or so. XLC topped back in the beginning of September, been working its way lower. It's in a bear flag. I don't expect that it's going to break below the 79. If it does, it's probably going to be a great opportunity to get in. I think that would be a really big positive divergence, very similar to what we saw in energy. And let me refresh. I'll see if I can get that energy chart up. All right. Hey, they're all up. Okay. So energy, when this went back down, I don't know if you remember, but when we were up here at about 47, 48, I kept saying, if we go back down and we set this new low, we're going to have a positive divergence. And there's that new low. And here was the higher PPO. Now, from there, what we look for is a 50-day test. I was not expecting that energy was going to take back off again and go through 50, but I did think we'd probably get a little bit of a pop back toward that 50-day moving average. We got almost up there, looked like we were rolling over, had another head fake, and then boom, to the upside on energy. Now, I don't know how the XLC is going to play out, but you can kind of see the similarities. Big move down, then we bounced back up, traded up a little bit. Then when we came back down, we had the positive divergence. Kind of similar here. Big move down, went up, kind of pulling back. But if we set a new low, going to see a positive divergence. From there, I would expect a 50-day test. But because we're in a long-term secular bull market, and this is one of your aggressive groups, I don't think that this is going to be held back at 82. I think eventually we'll break up and out again. I think it's just the XLC going through a period of consolidation, and money is rotating out of the group temporarily. We've seen that with many groups. We saw that with the consumer discretionary group before all of a sudden they just caught fire. So it's just this normal kind of rotation, maybe not quite so normal for 2021. It's been maybe rotation on steroids, but yeah, I expect the XLC will turn back up in time. Industrials, you can see making the move up, getting close to its all-time high. We're getting ready to go into November. November's a very strong month for industrials. I'll show you that in just a minute. But getting up close to the high and then rolling back over again. So I think, after maybe a little shallow pullback, if any, I do expect industrials are going to break out. All right, I didn't get a chance to look at this mid and small caps with you earlier because the charts weren't coming up. But here you can see the mid caps breaking out above prior highs. Small caps doing the same thing. We did put in reversing candles yesterday. Maybe we see a 20-day test here. I don't know that we're going to see a whole lot more than that. At least I'll be surprised if we do. So I think those could set up as possible moves to the upside. All right, let's see. We're going to go take a look at that Treasury yield. And wanted to pull up the durable goods report while we do that. Okay, so here's the 10-year Treasury yield to give you the update where we stand right now. We are now testing the 20-day. So this is the 4th day in a row we've been down on the Treasury yield. That's that normally makes it a little bit tough for financials. So maybe we may see financials underperform today. We'll have to wait and see. But 1.57%, we were up near 170 just a few days ago. But this is a kind of a normal pullback. We're in a short-term uptrend. I would say midterm, kind of more sideways consolidation with almost like a little cup here that's been forming. And then long-term, we're actually still, I believe, in a long-term downtrend. I mean, if we look at this on a long-term 15-year monthly basis, we had this huge drop because of the pandemic. We've gotten that back, most of that back. And now we're just kind of consolidating here, but still the overall long-term trend. And if we go back, I mean, I could go back, 50 years here. And I mean, since 1981, we're going down. We have periods intermediate term periods like in 2016 to 2018, where we saw yields rising, 2012, 2013, yields rising. You notice one thing about these two big moves to the upside in the yield. We had huge runs in the S&P 500, both of those periods. Well, we've done the same thing here. That's one of the things we talk about. The rotation between the bond market and the stock market is very, very important. When the stock market, when we're expecting GDP to grow, or if it's in the process of growing, you want to get out of bonds and you want to be in the stock market. You're going to do better in stocks than you're going to do in bonds when you're in a stronger economy. And so that has helped to fuel as much as anything this rise to the upside. And I remember talking about this in the fourth quarter of 2020, we were starting to rally back and people were saying, well, what could possibly be a catalyst to drive the market any higher? I mean, we're in a pandemic, the market, countries were closing. How could this go any higher? Well, it's a simple matter of money flow. Forget about everything else. Forget about all the news stories. I'm not saying that news stories aren't important. It's just news stories don't drive the stock market. Stock market looks ahead. Stock market doesn't care about what's happening right now. Things that we think are important because the media highlights them all the time. The stock market's looking past that. So you can't pay any attention to that. What you need to pay attention to are the technical signs and the intermarket relationships. That's going to give you a whole lot more knowledge about the likelihood of the market going higher or not than any news story you're going to read. So anyway, there, and I can point this out. Let me, let's get rid of that. All right, so let's do. All right, let's take a look at this. So now here, we're going down. This is the S&P 500 going up. And if you take a look at where we saw these big moves, here was 2009, 2010, pretty good move in the market, in the stock market when the bond yields were going higher. 2012 to the beginning of 2014, right here, stock market going straight up. Because you have to understand what drives these yields higher is money selling or treasury selling. So you've got proceeds coming out of the bond market and going into the stock market. The selling of bonds drives yields higher. So there you can see that move. Here, you got the selling of bonds from 2016 through end of 2018 or into the fourth quarter. Well, that was coincided with another big move in the stock market right before we had the fourth quarter meltdown with the trade war. And now here come the yields up and look what's going on. So if the yields stabilize, I think probably what we're going to see is just money rotate more toward growth stocks. I think the stock market, if yields stabilize, we're fine. If yields go back down, I think the market will be choppy, but I think your growth stocks will lead. If we stay where we are, I don't know that the stock market goes flying. I think we set new highs, but we'll probably be a little bit more, a little slower. Think back to 2014, like right here when the yield started rolling over and turning back down, we did keep going higher. But I would say the rate of growth was slower than what we had seen previously prior. So the slope was maybe coming down a little bit. And that's kind of what I would expect here. We've been going straight up. I think the straight up from 2,500 on the S&P to 4,500, actually we were down to 2191, I think at the low. But that straight up move, that rate of change is going to change. We're going to slow down and probably, look for more moderate gains, I would say. I do think over the next year, we'll probably hit 5,000 at some point. We might get close in the fourth quarter. I think probably we're going to come up a little short. I had said back at the beginning of the year, I thought 4,700, 4,750 would be the area on the S&P. And I think that's probably still going to be a pretty good number by the end of the quarter. All right. Wanted to show you the XLI. Actually, let's do that seasonality. So just looking at the last 5 years, you can see the XLI. Look at November. Last 5 years gone up every year and averaged going up 7.1% just during that month over the last 5 years. and I've done this before, so if this is a repeat for some of you, I apologize, but it's important, I think, for anybody who hasn't seen it to know the seasonality that we have coming up. That's 6 years on the XLI. Notice November still 100%. There's 7 years, there's 8 years, 9 years, 10 years, 11 years, 12 years, 13 years. 13 years in a row, the XLI has gone up. It hasn't been since 2008 was the last year that we saw November go down for the XLI. So the last 13 years, it's been up every year, averaging over 13 years, averaging 4.9% in the month of November. So when I showed you that XLI chart on the candle glance, when it was up near resistance, and I said, I believe we're probably, we might have a shallow pullback, but I don't expect much. I think we're going higher. This is partly why. Also, the transports have just been on fire. And I'm going to show you one that I shared with everybody in the EV Digest back on Monday morning. But I want you to take a look at UPS. And let me drag this as far back as I can go. 20 years. And look at this, 95% higher in November. That's 19 out of 20 years. 5 percentage points, the average gain for UPS during the month of November. Now you might think, well, December should be the good month because that's when they're delivering all the packages for Christmas. Again, market anticipates. So the fact that, it goes up in November and it doesn't in December is not a surprise to me. But November, that's pretty, that really stands out like a sore thumb, almost literally. It looks like a sore something, thumb, finger. 5% per year over the last 20 years and 19 of the 20 years higher. And when we look at the chart of UPS, it just made this breakout. So we're heading in, we're less than a week away from November, and we're just making a breakout. Volume's picking up. AD line is strong. And if you look at the relative strength on UPS, this is it versus the delivery services, its delivery services peers. It's going crazy. And if you look at it relative to, say, FedEx, it's not even close. Let's come down here and let's get rid of the candlesticks. Here is UPS versus FedEx. Which one would you rather own? UPS, it's been eating their lunch since March, going straight up versus FedEx. So if you're in FedEx and you haven't, you're not satisfied with your performance, well, UPS right now definitely is being favored by Wall Street. That'll change. If we pull this up, let's do this up here. All right, get rid of the volume. Oops. And we'll go back. Let's go back 30 years. We'll do a weekly chart. You can see if this goes back and forth. So UPS underperforming for almost a decade, then outperforming for a couple years, then quick underperformance, then outperformance, underperformance, back and forth. But right now, if you look at where we are now, we are breaking out to the highest relative level since back in 2002, UPS versus FedEx. Now, the challenge is trying to figure out when it's going to reverse and go back down, because it can be pretty brutal in both directions. But right now, there's absolutely no doubt in my mind who Wall Street is favoring. And so until you start to see this line turn back down again, UPS would be the choice here. All right. I don't think I ever gave you that durable goods report. I'm actually looking back at my notes here. Let me see if I can get that for you. So durable goods came in, the actual number was minus 0.4%. Consensus, though, was minus 0.9%. So it was better than expected. But if we strip out the transports, then durable goods actually went up 0.4%. The consensus was 0.5. So it came in a little shy there. But durable goods is very, very volatile. You're probably better off looking at a few months at a time and just kind of averaging them out, because they do tend to be very, very volatile. For instance, last month, this was for September, I just gave you, minus 0.4%. Last month for August, they were up 1.8%, which they were just revised down to 1.3%. So you can see the numbers are all over the place for durable goods. Anyhow, what else do we have for today? Today was kind of weird prepping because the charts I was unable to really get to come up for me. But let's take a look at, I did want to go through the sectors, the relative strength on the sectors, and just show you, first of all, technology's hanging in fine. Consumer discretionary, as expected, look at what's going on here. Once we broke this relative wedge, and once we hit this -1 level and started to turn up, that was a sign that consumer discretionary was going to lead going forward. You can see this is relative momentum, and you can just follow the PPO. We just go through these periods where we see tremendous leadership, and then the group consolidates. And if we go back and we look at technology, I mean, you see similar. I mean, it's maybe a little bit more consistent strength in technology, but then we'll go through periods where we struggle. We did that earlier this year, February to May, if you remember, when the CPI and the PPI were coming out much higher than expected, and all the talk and all the media headlines were, oh, inflation this, inflation that. Hey, I'm here to tell you, inflation is not good for growth stocks. So if inflation was a problem, this move to the downside would not have stopped. Technology would not have all of a sudden begin outperforming again. And so we've seen technology outperforming now since that May low, with inflation still high and people still talking about it and headlines everywhere. But the stock market, if you just follow where the money's going, the money is telling you, don't worry about inflation. Now, if we start to roll back over again and we set, a 2-year low in relative strength on technology, and some of the other growth areas are also taking a hit, then yeah, that's completely different animal. But right now, we can't anticipate and say, oh, that's going to happen. If it was going to happen, I don't think money would have rotated back into technology the way we've seen it. Companies like Tesla, when you're basing most of your value on future growth, inflation is a killer because it eats away at all that future growth. Valuations would come down substantially. So I'm not buying into the inflation argument, not because I don't see inflation around me. I see it. The charts are telling me don't worry about it. All right, let's go into communication services. So here's communication services. Notice how strong it had been. Well, it's having its move down, kind of like we saw in the second half of 2018. Had that huge move up. It was just too much. And then we pulled back, got back down close to the prior low. Here, probably too much. Now we've worked our way back, getting close to this prior low. I would suspect communication services will probably start getting a little bit more love in the fourth quarter, later in the fourth quarter, possibly, as soon as, next month, November, we might see it start to turn around. But right now you can see that relative weakness is pretty strong. Industrials, this is one that's really been confusing for me. It's come down so much, and maybe that was a little bit of a head fake, but I really expect over the next 4 or 5 weeks for this to strengthen rather considerably. We'll see whether or not I'm right. Outside of the pandemic, I want to annotate this for you because I think this is pretty important. Similar to what we saw with the XLY. I mean, when you get to that -1 area here, relative strength, here at -1, relative strength, coming down here at -1, relative strength, -1, relative strength. The pandemic was just a one-off. I mean, there's a lot of weird things that happened last March that we don't typically see. But here we are again, just hitting -1, and we're starting up. So I think that this is a group that's going to head higher, and seasonality tells us the same thing. And then the last aggressive group is the financial group, which has been doing well. This is going to depend somewhat on the 10-year Treasury yield. If the yield flattens and inflation kind of starts to go away, which I believe it's going to in 2022, I don't know about these next couple months. I did show everyone a pretty interesting report of the Core Cpi, 12-month rate of change, which has already started to roll over. Let me see if we have time. I'll tell you what, I'll try to do that as one of the 3 you must see, because that is a chart that you must see. But let's take a look at some earnings before we get into the 3 you must see. Just going to make a note so I don't forget about the CPI. Okay. And believe me, in 2 or 3 minutes, I could forget it. I think I'm at that age. Anyhow, let's take a look at some of these earnings, and I'm going to pull them up just in real time, pre-market, see what they're doing. Microsoft, I'm just going to go through some of the bigger companies. Microsoft up 2%, 227 versus 206 on their bottom line. Easy beat there. Alphabet or Google, easy beat, 27.99 versus 23.13, but the stock's showing almost nothing. I think this is going to run into the Amazon problem from a year ago. Remember when Amazon doubled in a fairly short period? It was like 6 or 9 months. And then we've been paying the price for the last year. It's been sideways consolidating. Google might do the same thing. I mean, we had such a big move. Now we got a big earnings report and we're seeing no movement. So we might be in this sideways consolidation period for a while. We'll see. Visa, 162 versus 153, stock down 3%. Market didn't care. Texas Instruments, 207 versus 206, not enough. And I'll pull this chart up because you look at it and you say, well, Texas Instruments is going up. Why was it such a, why is it getting a nasty reaction? Well, it's going up, but semis have been going up. And if you look at Texas Instruments on a relative basis, we're down near a 52-week low relative to semiconductor peers. So the market really not overly impressed by Texas Instruments and what's coming down, what's in their pipeline. How about AMD? Now, this one is one that has been very strong. They came out, they beat 73 cents versus 66 cents. I just think a little bit of profit taking. I think we had a huge pre-earnings run. I wouldn't be surprised to see a little pullback. Hopefully we'll get back to the 20-day. I don't know if we get back down that far on this move or not, but maybe. Twitter missed. Expected 17 cents, came up with a loss of 54 cents. Now, I did not go and look to see what was going on, but you can see the stock's been sideways, like Google, not performing well. This has just been an area of the market that's struggling right now. And I can't imagine it's just going to take off unless they did something raising guidance, which I have not seen. Twitter missing is a little bit of a problem. How about Robinhood missing? There were only 3 companies yesterday after the bell and before the bell that I saw that missed. So we had Twitter, we had Robinhood, which is down 9%. They were expected to lose $1.37. They lost $2.06. Not good. The other one that missed, you'd probably guess it, Boeing. Boeing came in, expected to lose 17 cents. They lost 60. They're up 1.6%, but it's probably a relief rally. I mean, I still see nothing on the chart that would suggest that I want to jump in here. Last one I'll give you, and I'll make this the first, I'll give you 2 earnings for 3 you must see, and then we'll do the inflation last. So the first one I'm going to go with is TMO, which is Thermo Fisher Scientific. Huge beat here, 576 versus 467. You want to know why we've had this huge move and why we're in this little bullish pattern here, cup with a little handle? It's because the stock, Wall Street knew things were bright with the company. 576 versus 467, that's a huge beat. So Thermo Fisher looks good. Coca-Cola reported 65 cents versus 58. So they did beat there, but this is a company that's been weak for a while. Looks like it's going to break out of this near-term trading range. So if we can get back through the 50, I would just like to see the stock hold these 2 moving averages going forward. And then the last one I have for you, I'm going to do the dollar Core Cpi. I'm going to pull up a monthly chart. We're going to go back and just do a line chart. We're going to go back 50 years. And then down here, we'll do a rate of change. 12. That should do it. So here's the inflation numbers, monthly core CPI. This is what I was talking about. See how the inflation was rising, starting to roll back over? Well, if we do this and we look at the core PPI, same chart, the PPI is still going up. So producer prices are going up, but they're not, it seems like they're slowing down in terms of passing it along to the consumer. So that's going to be interesting because these companies are making a lot of money. So they may be making the choice that, yeah, our prices are going up, but we're not going to pass it along to the consumer because maybe they feel like it's temporary. I don't know. All I can do is show you the numbers. The core PPI is still rising. The core CPI, if we look at that, is starting to roll over. Now, have we peaked? I don't know. Something to watch. I think these are two interesting charts. Anyway, that's it for me. I appreciate you tuning in today. Sorry for the charts earlier. Everything seems to be doing a little bit better now. We've got the NASDAQ up 45, S&P up 3, Dow up 27. So shooting for new records. Hopefully, we'll see whether or not we get there on the NASDAQ. But overall, at least a decent start to today's action. All right, please join me tomorrow for your next Trading Places Live. That'll be over at Stock Charts TV. So right where I got my cursor here at 9 a.m. tomorrow, all you do, click on that link, and it'll bring you right into the show. Love to have you there. Everybody have a great rest of your day, and hopefully see you tomorrow morning. Happy trading.